I'd like to welcome everybody to our webinar this morning, which is all about the complexities of Brexit and VAT. I'm delighted to be joined by two of our partners here at Brown Butler. We have Craig Hughes, who is our partners tax director, and we're also joined by James Hurst, who is our VAT director. So welcome to you both. Before I hand over to James, just a couple of housekeeping issues. We have scheduled time at the end of the webinar today for questions. So if you'd like to pose any questions, either to Craig or to James, please use the Q&A option on your Zoom toolbar. We'll get to see the questions as they come through, and we will try and answer as many as we can before we get to the end of the session today. If for any reason we run out of time, the questions will get captured and we'll try to come back to you where we can on a one-to-one basis. So I'm now going to hand over to James, and I will see you at the end of the webinar for our Q&A session. Over to you, James.
Thank you, Jo. Morning, everyone. Looking then this morning at the VAT changes arising from the Trade and Cooperation Agreement, I heard someone say recently it's better to not to think of it as a free trade agreement, in the sense of total freedom of trade between the UK and the EU, but rather as a preferential trade agreement, since although there are a lot of freedoms in terms of moving goods between the UK and the EU, there are many measures that you have to consider, and of course there have been an awful lot of changes, as we've been seeing in the last couple of weeks. It's definitely life won't be as free and easy or as frictionless as life within the single market for VAT purposes. The agreement is noteworthy in the sense of there's no customs duty tariffs on movements of goods between the UK and EU, but that is subject to a number of conditions, primarily around origin, which we'll come back to. There's a lot of change to digest. The agreement's over 1,000 pages long. Some of us have their own copy to read through. It's a challenge for all of us getting to grips with it, in the same way as remembering when the single market first came in 1993. It's changing an awful lot of the areas of VAT that we're used to dealing with. Looking through at the headlines in the agreement, and on the next slide, there are still some formal steps towards ratification at the EU end, but the basic framework's here to stay. And although the headline has been that trade is tariff and quota free between the UK and the EU, this doesn't apply to all transactions, and there are a number of conditions to consider, especially around origin of the goods. I'm talking this morning primarily about VAT, but there will be quite a bit of mention at times around customs duty, because there is an awful sort of a lot of links between the two areas. And what we're seeing at the moment already is that there are a number of issues have come up, some sort of expected, some unexpected, and there are daily updates to the official guidance, and political changes are pushing some of these, and so there are lots of amendments and fine-tuning of how things will operate that's emerging as we go. The main changes so far in the agreement are about movements of goods rather than the changes to the treatment of services. And so this morning we're focusing really on the goods aspects, and we'll come back to services a bit later on. It's certainly the case that there's now additional administration, which is prompting people to look and review their supply chain, having to do things differently, potentially even stopping some activities because of increased costs of compliance, and also revisiting commercial arrangements with suppliers and customers, particularly around Incoterms, the internationally agreed trade terms that determine who accounts for imports and exports and transport costs. moving on to the next slide, the sort of headline VAT changes. Personally, I think there's a sense of getting on with it at last, of moving forward after sort of 4 years of trying to second guess what the changes might be. The challenge from speaking with clients over the last couple of weeks is that we haven't had any significant lead-in time to see what all the changes are and get to grips with them. You know, we're having to hit the ground running and get to grips with it as we go. The headline that there's been that there's no quotas or tariffs for trading goods between the UK and the EU. That's true, but only where the goods are of UK and EU origin. And that's a really significant point, this point about origin. Looking at some of the sort of welcome news on simplifications in VAT, there are fewer boxes to complete in the VAT return, so you no longer have to record EC transactions. There's no EC sales list to do from January. There's reduced intrastat requirements, no dispatches anymore, only intrastat arrivals if you're above the 1.5 million threshold until at least the end of 2021. There's a great new relief on import VAT accounting called postponed import VAT accounting. It removes the cash flow cost and deferment requirement for import VAT. So now that we're out of the single market, bringing goods in from EU countries, they are no longer EC acquisitions, they are imports. So potentially import VAT is due at the point of entry into the UK. And historically, import VAT has had to be paid up front to customs in order to clear those goods through customs into free circulation. So you're paying the VAT up front, either directly or through a deferment account. Running a deferment account costs money in terms of bank guarantees and so on. The new postponed import VAT accounting says that you can account for the import VAT as a book entry in your VAT return, rather like a reverse charge. So it goes in both sides of the VAT return. So there's no cash flow cost. You don't need a deferment account. You don't have to apply for this treatment, but you do have to elect for it in the import documentation. So your freight agent needs to tick the right boxes when making the import entry. There's a transition relief, goods that were sold pre-1st of January, but delivered afterwards are treated under the old pre-agreement rules. There are lots of little changes in the VAT rules that we're seeing in the guidance that are a long way away from the headlines, but they're all sort of quite helpful. There are some relaxations around the requirements for indirect exports, which is where your customer is responsible for collecting the goods and transporting them out of the country, for example. The UK has now got freedom on zero rating. Now we're no longer part of the EU. So in the past, where the UK had removed zero rating and added VAT sectors on domestic fuel and power, zero rating could never be restored under EU rules. And that's why we went from 20% VAT on domestic fuel and power, and now we could only go back to 5%. And so there are, some changes there. And the rules around VAT and export of services, that's a lot simpler. Going a bit more into detail on the next slide, looking at imports first of all. This slide looks at imports, my next slide looks at exports. There's a lot of crossover between the two because one man's import is another man's export. So a lot of the sort of VAT changes that we come up with to embrace both of them. As I said, a fundamental of VAT law is that VAT is a tax on imports unless there's a specific relief. So if in the UK you import foodstuffs, for example, those are zero rated in the UK, so the import is zero rated. But otherwise, for most categories of good, if you're now importing them from the EU, then they're subject to import VAT. Now, as a result of the agreement, there's now additional paperwork. A lot of these declarations are electronic these days, but there are more customs procedures to get to grips with. This sort of headline about no customs duty or tariffs on imports into the UK, that applies only to EU origin goods being brought into the UK. And so origins are a crucially important customs topic here. And so you have to look beyond that headline and understand that the UK and the EU are not in a free trade area in the sense of goods can be freely moved all the time between the two jurisdictions. Goods can only be imported into the UK from the EU on a completely customs and tariff-free basis if they are of EU origin. And the opposite applies. UK goods can only go tariff-free into the EU if they are of UK origin. So it's very much about the economic origin of the goods and not where they've been shipped to or from. So to give you an example of something we've seen in the last couple of weeks since these new measures have come in, a UK company imports goods from China and exports those goods in the same state to a customer in France. Those goods leaving the UK and going into the EU are not of UK origin, they're of Chinese origin. And hence, they're potentially liable to import duty when imported into France. And then this raises questions. So who pays that duty going into France? Well, it's the importer. But then who acts as the importer? Well, then that depends on the Incoterms, the terms of trade that are agreed between supplier and customer as to who deals with the import formalities. What rate of duty applies? Well, that depends on the commodity tariff of the goods. And it still might be the case that even if duty applies in principle, because those are not UK origin goods, the rate of duty could be nil or it might be very low. Another example I've seen is where a UK customer, a client, is importing goods from the EU, say from France, and those goods have come in from India and they're being moved through in the same state without any sort of processing or change within France. Those goods coming in from the EU to the UK are not EU origin goods, so they're not automatically relieved of customs duty per the trade agreement. So they are potentially still liable to duty when coming into the UK because they're Indian origin goods in this example. But that said, it may not necessarily be a big problem because a lot of goods coming from, especially from developing countries, have very preferential nil rates of duty. So already, you can see that origin is important. Is there a risk of double duty? Well, yes, there is. And it's something we've not had to think about for many years in our trade with the EU. A kind of detailed explanation of the rules of origin, I think, is beyond the scope of this morning, but it's the rules of origin are a very well-established framework, and there's for customs purposes over the years. And there's an awful lot in the new trade agreements, various annexes that deal with the rules of origin of the goods. And so that's goes back to that fundamental point that the goods are only free of customs duty if they're UK origin going into the EU or EU origin coming into the UK. And the rules of origin look at, if you like, the economic nationality of the goods. And there are all sorts of rules that deal with if you do work on goods and incorporate goods from different countries, do you change the origin of those goods, and can you import various items into the UK and add them into UK origin goods without disturbing the UK origin? So all of these things are quite important because now for imports and exports, there have to be declarations around the origin of the goods. So if you're importing goods into the UK, you need a statement of origin from the supplier that those goods are EU origin in order to get the beneficial tariff treatment. And there are some transitional arrangements around that where, as the importer, you can use your knowledge to certify the origin of the goods. Going back to our focus on VAT, what we see at the moment is that, say, as a UK business importing goods from the EU, because those are now imports, there's a lot of discussion between suppliers and customers where for example, the customer might be asking the supplier to clear those goods through customs and deliver them duty paid. And the sellers probably almost certainly want the opposite and not have to bother with not just exporting the goods, but also doing the customs clearance in the country of destination. So there's a clear commercial tension between the two, and I've seen that with clients already in the UK, where the delivery terms is that the supplier has agreed to deliver those goods to our UK client. And whilst we were all in a single market, that wasn't a big issue. But now all of a sudden, because now there are import formalities to deal with to clear the goods through UK customs, then the suppliers are saying, well, actually, we don't want to do that. We'll leave you, the customer, to deal with the import formalities. And so there's a kind of commercial negotiation around the Incoterms. And there are people try it on. Overseas suppliers will say, oh, well, I'm an overseas supplier, I can't deal with the imports because I'm not allowed to register for VAT in the UK. Well, that isn't true. If that overseas EU supplier was responsible for the import into the UK and an onward supply of those goods in the UK to the end customer in the UK, then they'd almost certainly need to register for VAT in the UK. They could use postponed import VAT accounting. So it would be a fairly simple process, but they'd probably have to register for VAT in the UK and account for VAT on the onward supply here. And of course, the opposite applies with goods being exported from the UK into the EU. Another example, I suppose, around origin I've seen recently, and it's similar to the news reports on Percy pigs being manufactured in Germany and sent into the UK. There was an example of food manufactured in the EU being sent in bulk into the UK. This food product was being repackaged and some of it was being sent back to the EU, but then was potentially subject to EU tariffs because it was although it was coming from the UK, that item was deemed to be of EU origin, not UK origin. And so there are sort of processes, procedures that could be followed where this creates some headaches. There are reliefs around inward processing and outward processing, and when you send goods to another jurisdiction for repair without triggering a kind of export and import cost or tariff cost. But generally those arrangements all need approval, and generally it's better to get approval in advance. One of the things we've seen then with import VAT is potentially the need, no longer to have a need to operate a deferment account for import VAT, because you can use this simplified import postponed accounting. But deferment account might still be required for customs duty if you need to pay customs duty. There are also, if you do need a deferment account or want to operate one, there are now also reductions in the requirements to provide a security. Looking at some of the VAT changes, there's quite a lot to do on imports as well as exports on online sort of mail order sales and low value consignments. So in the UK, looking at imports where the value is £135 or under. From 1st of January, there's no import VAT on consignments below that threshold. And that's because, and that sort of means that there are millions, I suppose, of individual small packets that potentially would need to be cleared through customs in the UK and coming in from the EU. But if you are an EU online supplier of those small packages to customers in the UK, VAT still needs to be accounted for on that supply. And so rather than have import VAT, there's now output VAT, and the overseas supplier of these small packages is now required to register for UK VAT and account for VAT on the supply. If the value of the imports coming in is £135 or more, then it's still an import for VAT purposes, and then it depends on the terms and conditions as to whether the supplier deals with the VAT payment or whether the customer has to stump up the VAT through the courier or Royal Mail and sorts it out. I suppose the question is, is that necessarily relevant to me? But I've already seen an instance with a client who needed a spare part for their tractor, which they normally source from a supplier in the Netherlands, and it's under £135. And the supplier in the Netherlands said, yeah, but that means I now need to register for VAT in the UK in order to sell that to you, and I'm not going to bother. And therefore, there's the hassle of trying to source that part from somewhere else. So just to kind of summarise where we are on import VAT, one of the things you should be doing is for any trade, imports, exports, is making sure that you've got an EORI number, an economic operator, a registration number, which you apply online to HMRC for. You need to check your Incoterms to be clear about who's the importer of the goods. Is it you as the customer, or is it the seller? You need to be clear about the commodity code of the goods. You need to be clear about the origin of the goods to make sure that there's no customs duty on the goods coming in from the EU. And I guess also on where the supplier has given a statement on their invoice about the origin of the goods and saying their EU origin, there's also a legal point about if the supplier's statement was like misleading or incorrect, what recourse would you have if it was later picked up and there was a charge to import duty. Moving on to the next section, looking at exports. Clearly, a lot of the issues that have been discussed around imports also apply to exports. That there are now different formalities now that we're no longer part of the single market for VAT. With VAT on exports, I think it's important not to overlook the basics. And one of the common areas for problems with exports, even before all of the changes from 1st of January, is about obtaining and retaining commercial proof of export. And that's particularly the case where there are indirect exports and you have your customer who comes in and collects the goods from your factory and arranges the transport. There's a higher burden of proof of ensuring you've got commercial documents that show that the goods have left the country. As we said, the Incoterms are also important. So as a UK business exporting into the EU, that's fine. The goods are UK origin. There's no duty to pay and so on, but there will be import VAT applicable as the goods come into the EU. If your customer is acting as importer and is responsible, that's all fine. They pay the import VAT and claim it through their VAT return. But what if the Incoterms are something like delivered duty paid, where you as the seller are responsible? Well, that is now, in most cases, will trigger a requirement for you as the UK seller to register for VAT in that EU country. Now, you could simply just pay the import VAT and clear it, but you'd almost certainly not be able to recover that, and it would raise questions about the onward domestic leg of the supply. And so, in most cases, it means that you need to register for VAT in the other country in the EU, account for local VAT. And in fact, most EU member states operate some similar simplification for import VAT, where it can be accounted for as a book entry through the VAT return, although in some cases you need to apply for this in advance. UK exporters must show their EORI number and identify themselves on the invoices and the export documentation on this, and put in a statement of origin of the goods such as on the invoice, and again the trade agreement in one of the annexes includes the form of words to be used for that. If you have to have a VAT registration in the EU, there's a question as to whether you're also required to have fiscal representation. In some cases you do, in some cases you don't. There's no consistent answer for all EU member states. But if you do, then and have to have a fiscal representative, then they're required to guarantee your VAT payment to the local tax authority, and that normally involves a bank guarantee and therefore additional cost. Germany doesn't require full fiscal representation at the moment. France, just in the last few days, has amended their requirements for the UK. So this is very much a developing area as the other tax authorities get to grips with how to treat UK businesses. And generally, we're seeing some more relaxations to treat the UK a bit more favourably than other third countries in a EU context. Some UK businesses are simply thinking, well, actually, we'll create a subsidiary located in the EU, because then it can that subsidiary can benefit from all the EU simplifications for VAT without needing a fiscal representative, and we'll just use that as a hub for distribution around all our customers in the EU. There are some changes around selling goods to the EU on a B2C basis, i.e. selling them to consumers in the EU. Broadly speaking, it's a lot simpler now that all those sales of goods are now exports from the EU and zero rated. The complexity is around what happens about any import VAT when those goods arrive in the EU en route to the customers in the EU. There is a low value consignment relief has been kept in place until the 30th of June for goods coming into the EU. If they're above that threshold of €22, then potentially import VAT is due, and that might be payable by the seller or by the purchaser, depending on the terms under which the goods are sold. But unfortunately, this has been postponed until 1st of July. But from 1st of July, there will be a new system, an import one-stop shop, which will tax those transactions by saying that, that those goods will be zero rated from the UK, subject to import VAT when they come into the EU. That import VAT will be determined by the country of destination of the individual customer, but there will be a one-stop shop, so there'll be one VAT return through which you can account for all that import VAT, and that will act as a clearinghouse for the VAT rather than submitting multiple VAT returns. So I think that concludes my comments now for exports, and I'll hand you over to Craig to pick up some of the direct tax aspects.
Thank you, James. Yes, I just want to briefly mention some of the direct tax implications of Brexit. Clearly, the main impact is around indirect taxes, VAT, and customs duties. But there are a couple of things just are worthy of note. First of all, I mean, James mentioned there, one of the consequences from a VAT perspective is that you may need to register for VAT in an EU country. And that could also give you a taxable presence from a corporation, from a local corporation tax perspective. So that is something you need to be mindful of, as well as the VAT implications of registering in different territories. A couple of other things that are directly impacted from Brexit are around EU directives. Because direct taxes are largely governed by the individual member states rather than by the EU, there's very little impact on rates as such. But one of the, or two of the directives are, there's the Parent Subsidiary Directive and Interest on Royalties Directive. These were put in place essentially to avoid the need for any withholding taxes when paying dividends, interest and royalties between EU countries. Those directives no longer apply now, so we have to rely on the double tax agreements between the UK and the individual member states. And whilst in a lot of those cases, there will still be zero withholding on many payments, it is something that does need to be looked at and not pushed to one side or carry on as you did before, because you never paid withholding tax before. So we don't have to going forward. It is something that does need to be resolved. From a dividend point of view, it's actually quite straightforward outbound, because the UK doesn't apply withholding tax on dividends anyway, so there's no change from that perspective. It's probably more likely to be on any inbound interest, royalties and dividends. Another point just to pick up on is around state aid. This was a big political hot potato, as you may recall, during negotiations themselves. But there are some tax incentivized investments and tax incentives that we in the UK give to some of our corporates. But they are restricted by, or they were restricted by the EU state aid rules. So things like SME, R&D tax credits, enterprise management incentive schemes, EIS, SEIS, all of those schemes offered very tax incentivized investment and arrangements. However, they were restricted in their application because of the state aid rules. And so the types of company, the size of company, the nature of the company's trades were quite restricted in terms of which companies qualified for those various reliefs. Now, under the draft agreement, the UK will now pull away from the EU state aid provisions, but we will be looking at putting in our own equivalent provisions instead. And so it's, at this point in time, it's very much a case of what's his space in terms of what may come in and what impact it may have on those various tax reliefs that are currently restricted by the EU state aid rules. And finally, just one aspect I just want to deal with, which is popular in the press, and this is around overseas holiday homes. And so there is an impact of Brexit here. Firstly, in terms of the ability to travel freely within the EU, in that now there's a maximum length of stay of 90 days in any 180-day period. And that's looking at the Schengen area as a whole. So if you go into Germany and then go to France and then down to Spain, it's 90 days covers the whole of that period within the Schengen travel area. From a tax perspective, there is an issue in that a lot of EU countries tax non-residents based upon whether they are within the EU or EEA status for individuals. And generally speaking, there is a more favourable tax treatment for individuals who are EU residents compared to those who aren't. And just by way of example here, in Spain, individuals that have income over in Spain, say from a holiday let or something along those lines, the rate of taxation goes up from 19% to 24% from the 1st of January this year. And likewise, there is less flexibility in terms of the expenses which can be deducted from the rental income from a holiday home, for example. So that's just one illustration of where the change in our status for being out of the EU now could impact individuals and businesses alike who have operations in other EU countries. That's all I really wanted to say around the direct tax side of things. James has got plenty more to talk about on the VAT, so I will hand you back to James.
Thanks, Craig. Yes, there is plenty to talk about on VAT, and what I wanted to highlight in the next slide was about the ending of various VAT simplifications, which we've enjoyed as members of the single market. And part of the difficulty getting to grips with these is that no one really knew until the trade agreement was finalised over Christmas that whether any of these would be preserved. And in fact, there's still some uncertainty in some areas as to how things will operate. But some of the highlights are around triangulation. So for those who are less familiar with this in terms of the supply chain, if you as a UK supplier had a customer in France and you'd agreed to supply them with goods, but were sourcing those goods from a supplier in Germany, then you would almost certainly trigger a requirement to register for VAT in France in order to take the acquisition of the goods from Germany and make an onward domestic supply in France. But triangulation was a great simplification that meant that you could avoid a need to register for VAT in France and account for the transaction by ticking various boxes in your VAT return and so on. That triangulation relief has gone because triangulation only works if you if all the parties belong in the EU, and because the UK is now outside the EU and the single market, we can't participate in triangulation. So some businesses are looking at this and thinking, well, actually, we might set up a subsidiary located in the EU in order to benefit from triangulation going forward, to have some kind of hub located in the EU. Something similar has happened with call-off stock. So as a UK supplier, you could hold stock of your own goods at a warehouse in an EU member state from which to supply a single customer in that country, and they would call off the stock as and when required. And that transaction could be treated as an EC sale and acquisition without a need to register for VAT locally. That simplification relief for call-off stock has now disappeared, and we're already seeing cases where that's triggering a requirement to register for VAT within the EU, which of course then means an increased compliance cost. Potentially fiscal representative needs to be appointed depending on the attitude of the local tax authority. There'd been a good simplification with the mini one-stop shop or MOS scheme for online digital sales going B2C into the EU with a single VAT return acting like as a clearinghouse for those sales. It's no longer possible to use the EU MOS. You have to move your registration across to what's termed a non-union MOS to get a similar benefit. Supply and install contracts, again, there was a relief where if you were supplying and installing the goods in another EU member state, you wouldn't necessarily need to register for VAT, and your customer could self-account for the VAT in their own member state through their VAT return. It looks like that relief has gone. There's still some questions to be answered or asked and answered regarding the attitude of individual member states for non-EU suppliers. But broadly speaking, it looks like multiple VAT registrations might be required if your business is involved in supplying and installing goods. Now, also as a result of leaving the single market, there's it's now going to be a more convoluted process for claiming back VAT incurred within the EU, because we now have to move in the UK onto a different scheme that's seen as a bit more cumbersome and is a slower process. For any unclaimed VAT that's been incurred within the EU, definitely get your claim in by 31st of March, by the deadline. I've got a slide, next one, mentioning about Northern Ireland. It really is not to go into any depth about trade with the Northern Ireland. This is already generating quite a few queries. They tend to be very specific queries to do with the special status of Northern Ireland. My first thought around this is, having read the HMRC guidance on Northern Ireland and the new arrangements, it's the worst set of guidance I've ever seen. It's really unclear. Looking online, you kind of click through different bits and it takes you around in a circle and it never really properly answers all your questions. And already we're seeing through all the news headlines about disruption in trade between Great Britain and Northern Ireland, shows that there are more than teething troubles in terms of getting to grips with the arrangements. From a purely VAT perspective, it's relatively straightforward in the sense that Northern Ireland remains part of the UK, and that if you are supplying goods from Great Britain, then normal VAT rules apply and you charge VAT to your Northern Ireland customer. But at the same time, the Northern Ireland Protocol, agreed with the EU, says that Northern Ireland remains in the single market for goods. So the Northern Ireland is in the UK, but for goods, it's within the EU single market. And Northern Ireland is part of the UK customs territory, but Northern Ireland at the same time will also apply EU customs rules at its ports. And as we know, this is all about keeping the border open without a hard border between Northern Ireland and the Republic. So for VAT purposes, it's pretty straightforward in the sense of you charge VAT to your customers in Northern Ireland. Why would you charge VAT where Northern Ireland is part of the EU for VAT purposes? Well, going back to our sort of export-import discussion, trade with the EU is now an export and then an import, so you'd expect import VAT. But what the UK said is that rather than have import VAT for goods moving from Great Britain into Northern Ireland, you would have charge output VAT as a kind of proxy for the import VAT. So there's a lot to get your head around there. And a lot of the difficulties that have been reported in the news seem to be around the paperwork. And having spoken with freight agents over the last couple of weeks, they are predicting that there will be various changes and amendments to make things less complicated in terms of trading with Northern Ireland. There have been some unintended consequences. So one of the things that's come up was about selling second-hand cars, typically from Northern England across to Northern Ireland. As a result of these changes and Northern Ireland being part of the EU, then the second-hand margin scheme would not apply in Northern Ireland. So that meant that VAT would have to be charged at 20% on second-hand cars moving to Northern Ireland, which would obviously then vastly put up the cost of cars in Northern Ireland. There have been intense lobbying of government, and the government have already announced some changes to reintroduce a second-hand margin scheme. So I think that's just one example of probably a number of amendments that we'll see coming up shortly. If you are trading with Northern Ireland, registering with the Trader Support Service is a really smart thing to do, I think, to try and get better information. Moving on to the last sort of substantive slide, which is around just capturing some thoughts on VAT on services. Thankfully, there's relatively little change in the new agreement. In fact, probably overall things are simplified. Certainly, if you're selling digitised services from the UK to customers overseas, even on a B2C basis, it's a lot simpler because everyone outside of the UK is regarded as non-UK and is treated in the same way. If you take that on and apply that to services that are exempt in the UK, such as in financial services, insurance, and so on. Previously, when we were part of the EU, sales supplies of those services to the EU were also seen as VAT exempt. Now they're seen as outside the scope as specified supplies, which means that you can treat them as if they're taxable supplies for the purposes of VAT recovery. So financial services businesses get a boost in terms of improving their VAT recovery. Whether, as a personal view, whether that will remain going forward, given that there are still negotiations to be had as part of the overall trade agreement about the UK's access to financial markets in the EU, well, I think that all remains to be seen. And it's important also to remember that there are exceptions to the general rule for the place of supply of services. So even if you're supplying services like hotel stays, catering, land-related services in the UK, you might still need to charge UK VAT to an overseas customer, and conversely, an EU person making those supplies in the UK might be required to register for VAT in the UK. And then just on my final slide was just like a bit of a capturing some thoughts really. At the moment, it's really important to think about your supply chain, review your contracts, be clear about who the importer is, who's responsible for the import VAT, what contractual protection you have if there are disputes regarding the origin of goods. I think there will be some opportunities, certainly the £135 scheme on low value imports of goods means that overseas suppliers are less inclined to want to register for VAT in the UK, which might create opportunities for UK businesses. I've already heard several people mention about the thought of setting up an operation in Northern Ireland, because Northern Ireland is part of the EU for customs and VAT purposes, in effect. So it provides potentially easier access to the rest of the EU. But at the moment, I think my final thought is that it's definitely necessary to keep on top of the changes over the next few weeks, because new guidance is emerging daily on these areas. And that includes my comments this morning.
Okay, well, thank you very much, James and Craig. As you would expect, we've had lots of questions coming in. Some of them I can see have subsequently been answered as we've gone through the webinar. So I'll pick up on the ones where I think we might still need further clarification. So there's one here that came in from Philip, which is, in the past, we've imported new boats from Poland with no import VAT. How will this work going forward? And that's to you really, James.
Yeah, thank you, Jo. With goods being imported from Poland, well, previously those would have been treated as EC acquisitions. So where the question says no import VAT or no input VAT, I would assume that either those boats would have been in principle subject to VAT, but it would have been treated as an EC acquisition. And so the UK business, the UK acquirer, would self-account for the VAT as a book entry on both sides of the VAT return. If those boats qualify for zero rating in their own right under UK law, then the imports these days under the new regime would still be zero rated. So it would be a question of establishing whether the boat itself in any way qualified for zero rating in the UK. Off the top of my head, I know there's zero rating for houseboats, for example, that don't have their own propulsion. There is a zero rating for ships. I think there's a qualifying weight of 15 tons, but, and something that I have to look into in detail. So if there was like a zero rating relief, there would be no import VAT, but absent that, there would now be import VAT on any goods coming in from Poland. So the question then, going back to what we said before, is, well, who's responsible for that import VAT? Is the supplier in Poland delivering on duty paid terms, and it's their issue to sort out of clearing the goods through customs and dealing with any import VAT and onward supply within the UK, or is the UK customer the importer, and they have to clear the goods through customs and pay any import VAT? But as we said, if there is import VAT now, then it should be possible to elect for the postponed import VAT accounting by making the right entries on the import documentation and not suffering a cash flow cost of that import VAT.
Okay. A question here from Julie. Can an Irish company keep stock in the UK?
Sorry, Can
an Irish company keep stock in the UK?
It can, yes, it can keep stock in the UK, but I suppose the question is whether that company is then making a supply of that stock in the UK. So if the goods are physically in the UK at the time that they're supplied to a customer in the UK, that's going to trigger a requirement to register for VAT in the UK, because the UK has a nil registration threshold for non-established overseas suppliers who make supplies of goods in the UK.
Okay.
It would be possible to, I think, if goods were moved from Ireland into the UK and were kept in some kind of warehousing regime and not in free circulation, that would not in itself trigger a requirement for registration for VAT purposes. But once those goods go into free circulation, then it does potentially trigger a VAT requirement. Okay.
I'm going to squeeze one more in. The other questions, we're running out of time, so we'll come back to on a one-to-one basis. But I've got a final one that I'm going to squeeze in here from Amanda, which is we import household products from China and then paint and polish in the UK. We then import some to EC. Would this qualify as a substantive change to become a UK origin? That sounds very complicated.
It's a very good question. It's one I can't answer off the top of my head, but it totally illustrates, I think it's a really good question in the sense that it totally illustrates the challenge at the moment, because that is all around origin. Certainly if those goods came in from China and were sent on in the same state, then they would very clearly be of China origin, and therefore you'd have to look at whether that triggered a duty requirement on the import into the EU. Now, given that there is some processing going on, I think the point to make about origin is that there's no sort of broad brush answer to that type of question. You have to look in detail at what processing is being carried out, and there's once you get, there are several annexes in the trade agreement that look at this in detail, and one point to make is that there are sort of different sets of rules for different categories of goods. There's not a sort of one size fits all answer. You have to look very, very specifically at the work that's carried out on different types of goods, and different sets of rules to come up with the answer to that one.
Okay, thank you. Okay, well, look, there are lots more questions. We will try and get back to one basis. I just want to thank Craig, thank James for a very informative presentation. Thank you very much. For those of you watching, we will create a recorded version of this webinar, make this available on our website and through our social media channels, hopefully later today. And of course, if you've got any further questions or need help, please don't hesitate to contact Craig or James directly. You can find their details on our website. Thank you very much.
You're welcome. Thank you.
Thank you.
Cheers.